All right then. So we will also have Tomer Federman from Federman Capital, but I think he's not here yet. If he comes, we're going to get him on stage. If not, we'll be doing this together. Yeah, first of all, thanks for coming.
Thanks for inviting.
I mean, you've both been doing investments in blockchain for quite a long time. So let's start quickly. That's how long have you been doing this and what has changed since then? Because the point of this panel is actually what has changed and what's going to happen in the future. In the previous panel, they talked about equity versus tokens. We're probably going to be covering quite similar topic as well, but let's with you. You've been doing this quite a long time.
Yeah, well, I did my first kind of professional angel investment in blockchain, I think late 2016, just after I exited my previous company. So the first time I actually had some money, and I was kind of lucky enough to, one of the investments I did that was connected to blockchain. And the way kind of I saw it is that, and I haven't been like when I was kind of involved in other stuff, through 14 and 15, I haven't been actively involved, but what I remember distinctly is when I kind of went to the pitch events because I had a company in Berlin and we kind of went to, I felt kind of really bad for the Bitcoin people. Like we called them the Bitcoin people then because I was like, haven't you still given up? Like nobody's giving you the time of day, why are you still here? So it kind of went from nobody really kind of noticing them to maybe somebody startly kind of trying to do something like very early on with some early ICOs such as Ethereum, Augur, and maybe Economy. And then through this mass hype bubble in 2017, and now again I kind of see people are, you know, when they kind of, I meet them and say, oh, you're still doing the blockchain thing? And they kind of like look me with that look I gave other people like, oh, you haven't really given up? So I think we kind of made full circle, which is both good and bad, but I think overall kind of, the investing is coming down to basics again. Instead of like, who's gonna hype it more? It's about who actually like, which team do you think will be in it for the long run and deliver something of value? That's kind of.
And I'm going to get back to the question, but first of all, like, you've been also like exploring different blockchain projects for a while, and I wonder what has changed in the projects, in the blockchain projects, what they were doing in the past, what they are doing now. Can you just quickly summarize?
Yeah, and as a means of a quick introduction, just on our end at Fabric, been investing in different forms in the blockchain space since 2013 with the sort of Series A and Bitstamp back then, and so we've lived through quite a couple of different narratives in the blockchain space, all the way from 2013 where it was all about Bitcoin, then 2014-15 where people said forget Bitcoin, it's all about underlying blockchain technology, and sort of a whole bunch of enterprise blockchains or permission blockchains were coming in. Then 2015, 16 was, and 17 was effectively the rise of sort of, let's raise these massive ICO rounds, which turned out to whatever they end up being today. And now we're getting back to sort of normality, or at least closer to normality in terms of what projects are actually pitching, what they're raising, and what they're building out. And we can dive into it, very happy to do so in terms of like the different business models that were pitched along those sort of different narratives. There's quite a nice analogy towards the Web 2.0 area. If you think about the early, sort of, late 90s and early 2000s, a lot of the venture funding went into companies that had no revenues, that were basically just pitching that they have huge networks that should grow in value as they grow in network size, and they were burning a whole bunch of venture capital cash, and that all came down crashing. But out of those arose quite a few interesting business models. And so if you sort of try to put that back onto where we are today with the sort of Web 3 era, we can see that in the early days there was a whole bunch of different business models that might not have worked. Companies like Blockstream or Consensus basically held a whole bunch of Bitcoin and Ethereum while trying to make the Bitcoin and Ethereum blockchains more interesting or more usable and hence make the value of their assets go up. Then there was sort of the next wave which said, hey, let's try to sell a whole bunch of these tokens that are medium of exchange tokens to a whole bunch of users, and because these users will hold our tokens, they will be our early champions and they will create more value in the network. That turned out not really to be true because a lot of those early users just were speculators and all they were trying to do is send their tokens to Binance and hope for someone to type it up and effectively allow them to cash out. And so now we're getting to a world where actually there's credible business models coming out, whether that's sort of tokenized securities, as were mentioned before, which are interesting but not fundamentally different. They're sort of 1.1x or 1.2x better than what previously exists. But there's ideas such as continuous organizations, which have been pitched by someone like Thibaut Favre at Decusis, Or there's ideas such as work tokens, where you actually incentivize different actors within the network to do very specific work. And there's a lot of work and a lot of effort we're putting in with our portfolio companies to really think through how the different actors are incentivized within these networks. And so that's what we're most interested in now, moving away from past ICO hype, moving away from payment tokens, which don't really have a rational use case in terms of accruing value over the long term, and actually thinking why certain tokens would accrue value.
So, Damir, since 2016, you've been investing in blockchain companies.
Yes.
So, what form of investment you were doing? Like, was it like mostly ICOs or equity or what?
Well, I mean, initially it started with ICOs because they were kind of novel and new, and by the time they were peak hype, I kind of we tried to refocus. I say tried because not a lot of companies were at peak hype even offering equity. We kind of said, okay, this is nice, but the incentives are simply not aligned well enough with tokens. Like what we saw is, and what's going to happen now in the future kind of, is that you have a lot of people that got rich off their tokens, right? Yeah. And maybe it's not even the founders, maybe they're driven by their mission, by the promises they gave, but like for a lot of the early employees, I mean, they get, let's say, they have every 3 months, some of their tokens vest, right? Mm-hmm. And the tokens that vested in May, they bought them a house, right? The tokens that will vest this month will buy them a hamburger, right? So how many employees will stay on for the rest of their vesting for the 5 years, right? So you have this kind of flip model where you make most of your money as in a standard like startup. Basically you have nothing and then you have some early hype and then you actually have to build. Here, if you actually plan your liquidity around this early hype, you have like a lot of early money coming into first kind of hires and maybe early founders. And all of these guys now are not motivated by money at all. They're all very, very well taken care of, which kind of removes one of the motivations why people actually get into, like why they start a business, right? To make money. So you will see a lot of kind of companies just simply implode, like, or just they will like dissolve in like half attempts at work, and then maybe I assume a lot of them will just return money. And I think the latest kind of SEC kind of pressure they've been putting on some companies will just be a scapegoat for a lot of these companies to say, look guys, we gave it our best. We took 20 million for you, here's 10 back. We want to be fair. However, we're not mentioning that we also made 5 million on the way. So I think this is kind of, early on, these ICOs, they look like very promising. It seems like almost like an idea above investing in a sense. And then later on, it kind of showed that maybe going back to the old-fashioned equities actually makes a bit more sense. And I'm not saying tokens aren't kind of, for some projects, they don't make sense. I'm just saying you can have actually both, especially in the early start of the project. Once projects evolve into something truly decentralized, which I would be kind of willing to argue, if anything, except Bitcoin has actual decentralized structures in terms of organization, then you kind of lose the value of equity. But early on, you kind of need the equity to kind of keep everybody kind of on the same page.
So I'm asking about the future in the next turn, and actually I'm gonna ask a similar question to you. The role and nature of an investor in this space has changed. Can you tell us a little bit about that? Like similar to Damir, actually. What are the investors are looking at now? What has changed? What is their role now in the blockchain ecosystem?
I think it's an interesting point. If you look at sort of the traditional VC world, every venture capital pitches themselves as value adding. Generally, if you try to really dig down into what they actually do, they might help with 1 or 2 hires along the journey of a company. They might write a blog post and they will sort of post your updates on Twitter, but that's about it if you're being negative. But I think in this world, there's actually a real opportunity to not only help with some of those things, but actually also participate within the networks. So as an investor on our end, we've committed to participate within most of the networks we invest in. So for example, Ocean Protocol, we are running nodes on their testnet. We are providing data into their data marketplace. For Polkadot, we are running testnet nodes as well, for Keep networks as well. So there's a whole bunch of different networks that we are actively participating in, and it's under this idea that David Bushy, I'm not sure if he's here, but he has a talk coming up soon. We'll talk about generalized mining. We call it active network participation. But it's the idea that as an investor, you are more than just a capital provider, because capital has somewhat become cheap in this market. And so you have to sort of go beyond that. And the second point on that is that a lot of these networks are two-sided marketplaces where someone is providing storage or someone is providing computing to a whole market that wants to buy that. But what happens when the first user comes along and there is nobody actually providing that storage or that computing? A lot of people were pitching that these payment token models might actually incentivize early service providers to come into the networks, but if they're only paid out by user transactions, there's no reason for them to viably be providing that compute or that storage on day one. And that's the role of an investor who's incentivized by the long-term success of the network to actually come in, provide that compute or that storage or whatever the resource is on day one when it's maybe not economically viable to help bridge that gap for that network to actually survive and strive over the long term.
Cool. I'm going to get some questions, by the way. Don't worry, we're going to have plenty of time, hopefully. So I'm going to get some questions. So let's get the microphone ready. So what do you look at? Because when I talk to my friends, especially investors, a couple of years ago, they were thinking about returns from the ICOs or like blockchain investments. But now they all want to do long-term investments, and so they really consider projects with a good technology behind it. So they don't really care about what's going to be the return after the ICO, things like that. So what do you look at, and what is your really motivation for investment now?
Now or in general? I mean,
for the future. In general, or whatever.
For the future, I think
Probably when you invested in the past in the ICOs, you were also thinking about quick returns.
So, I mean, we actually, out of the investments we did with the fund, which are 9 investments up to now, we haven't sold a single part of it. So, effectively, all we invested, we still kind of hold. What we kind of looked at, as much as, again, it was a specific time where if you actually wanted to be a part of projects which had good indications that they might be valuable, the time window to actually make a proper decision was fairly, very, very small. So you had weeks, weeks is kind of maybe you had, in some cases, even days. So we kind of, a lot of these good investments we actually kind of had to pass because in some cases it was like, decide now. It's like, okay, no. I mean, it's an easy decision then. What we looked at, because a lot of the investments, what were kind of 2017-18, which was kind of on the market, were effectively layer 1 solutions, which when you boil it down what it actually is, and a lot of them, they're effectively Ethereum competitors, right? So if you're trying to kind of build an Ethereum competitor, you have a couple of angles that you can do it. So we sat down and said, okay, which are kind of the attack vectors where you can kind of find vulnerabilities in Ether, and you can kind of try to kind of scale on that and get some escape velocity for us. So there's a couple of things that Ethereum is kind of, not bad at, but it kind of, that may work. One of them is just plain out executing Ethereum on technical stuff, right? So you can have just a smaller team, doesn't need to kind of deal with the legacy, can take some learning from them and just out execute them, right? Then you have like privacy. So you have Ethereum's focus on privacy is now mostly focused on kind of their collaboration with a lot of outside projects. These projects also have their investors. Kind of incentives might not be aligned in the future, so somebody is being kind of a privacy thing first, whether that's connected to oracles or that's connected to kind of just general level privacy for transactions. I mean, if I want to send you some money, I don't really want you to know how much money I have in my bank account, right? That's the way kind of Ethereum currently works. Then governance.
Hello.
Oh, we have a latecomer. Welcome. So governance, another thing that kind of is lacking, a lot of other teams are trying to kind of do better. So there are a couple of these avenues that we kind of we looked at, and these were kind of boxes that we wanted to fill, and we were quite successful actually to finding a good representative with all of these boxes. And we try to kind of every 3 months reevaluate, okay, which is kind of the next thing, because I think in 5 years from now, when we're looking back, the most interesting things will have nothing to do with whatever I say now, right? I'm kind of old enough to remember when people were talking about smartphone in 2004 and 2005, and definitely nobody was mentioning Instagram as like a use case, right? And yet, so now it's like $100 billion company. Oh, it's part of Facebook, but if you would kind of take it out, it would for sure be valuable. 100 billion plus. So I think as you kind of build a part of the infrastructure and a part of the use cases, that use case, that is shown to work will kind of be taken apart and applied to other, and then this will kind of build it up, and then we'll end up with some plateau that will be just like completely beyond our current imagination, but it will be something like that will really, really kind of hit it home, right? So we just trying to kind of update and just keep our kind of, keep our eyes open and see where the trend's going and follow there.
So, Tomer, welcome on board.
Yeah, thanks. Sorry for running late.
It's okay. I mean, like, most of the events usually have delays, but we are on time now, that's why.
Yeah, of course, Murphy's Law, this is the one.
So, what we were talking was actually, I'm going to ask similar questions to you, but at one go, you can maybe summarize your point of view. First of all, we were saying, like, what kind of, what investors were looking at in blockchain projects in the past, what they are looking at now, and also the form of investment is changing. Like most of the investors were investing in ICOs, but now in the previous panel we were talking about like tokens versus equity. So maybe you can just answer all these questions with your own experience. And what has changed? What are you expecting for the future in both, like blockchain projects and also from the investment point of view?
Yeah, sure. So first of all, sorry again for running a few minutes late. If I can just make a quick intro.
Sure.
So my name is Tomer Federman. I'm the CEO of Federman Capital. We're a hedge fund focused on crypto and blockchain. We invest across the entire asset class, from taking positions in well-established cryptocurrencies all the way to investing in early-stage companies even before they launched. My background, really briefly, I've been in tech for 15 years, both working at startups and major companies. Most recently, I've spent the past 3 years at Facebook, where I led product strategy and global growth for some of Facebook's major ad products. And yeah, with regards to the question, pretty broad question, so can take it in a few ways. First of all, I think it's pretty clear that in terms of the form, public ICOs are pretty much dead right now, and I think that's a good thing. I think it's much better when you have that filter through accredited investors, which protects retail investors in many ways from, scams and things of that sort. So I think what we tend to see now is more like the traditional VC route for early stage investments, where projects go to funds or accredited investors, try to raise that initial capital, and from there kind of provide liquidity and enable retail investors to acquire their token as well via exchanges. In terms of interest in the space, actually our interest hasn't changed that much over the past year. We have different kind of buckets that we look at, whether that's decentralized exchanges, protocols, privacy coins, and so forth. I think what is changing, and there's a lot of uncertainty still, is regulation. Yeah. And we've seen also over just the past couple of weeks, right, the SEC getting quite involved and issuing some orders. And so that is something I would say maybe has evolved a bit in terms of our thinking, whether the projects that we're looking at comply with certain regulations, which again, there's some uncertainty, right? We have to make assumptions also what the regulation is going to look like and what is and isn't, compliant with that, because so far there hasn't been a lot of clarity. But that is something that I think, is becoming more and more important for us. More recently.
So what do you think about the future? Like, is it gonna, like, because currently, I think this is the worst day of crypto markets, right? Yeah, okay, like the prices dipped, and there are so many SEC news running all in the main media. But we are all here. Probably you are looking to the future with like positive feelings, I guess. So, what do you think? When all these dark clouds will just go away? You're going to see the sun, or things will be more clear. When do you think it's going to happen?
I'd argue that we might have gotten a bit ahead of ourselves with the price over the past year or two. If you think about what this really is and what we're really building, some people are arguing that it's sort of a new form of money, which is fine in certain cases. I guess Bitcoin, Ethereum to a certain extent might try to argue for that, or some of the privacy coins. But on a larger scale, I think the whole blockchain space is trying to build a new sort of wave of computing. And that's a distributed wave of computing which interacts with, on one side, sort of the IoT devices that are producing millions of data points per second with the AI and machine learning algorithms that can actually ingest those. And in between those, you need a substrate of decentralized data architectures that allow you to not end up in a dystopian future with certain sort of centralized companies owning all of that. And so if you're thinking about it from that perspective, where every single type of software that we can think about and every type of enterprise that we can think about will be changed in some shape or form by these distributed platforms, then that's something that takes decades to build up, if not one, maybe multiple decades. And so from that perspective, our view on investing hasn't really changed either. We have all the investments we've made have a long-term out view. When we invested in Polkadot, for example, we were betting on the fact that in 5-10 years' time, there would be a myriad of different blockchains that are interacting, whether permissioned or permissionless, interacting with each other and having to exchange state in between them. And so that hasn't happened yet. I mean, they've barely released Substrate, which is their toolbox to actually launch blockchains. And so from that perspective, it hasn't fundamentally changed now in terms of what they've built so far, and we're still looking forward to what they're building over the next 5 to 10 years. And the price doesn't really relate to that so much. The public price is what it is. It's driven by speculation, by hype, by shilling, whatever you want to call it. And for certain very few assets, maybe like Bitcoin, there is some actual technical pricing being sort of taken into account. But beyond that, all of the altcoins have had very little accredited or sort of institutional investors trying to weigh in on what price should actually be. So whether it's the lowest point today or tomorrow, or frankly, there's a good chance that Ethereum goes under $100. Or it doesn't really make a difference in terms of what view we take over a 5 to 10 year period with a venture fund.
Anything you want to add?
Yeah, so I guess it depends on how you look at it, right? You can say, like, we have these dark clouds and, is the future going to be brighter? I actually think it's pretty good what's happening right now. So maybe I take a bit of a contrarian view, but the craziness of, the beginning of this year and, late last year was obviously completely unsustainable and wasn't really based on any, fundamentals or, rationale, to be honest. And so what we see happening this year, I think, is a good thing. And it's good that we, a lot of the people who are not really bought into the, the transformative nature of this technology and kind of where it can take us are, starting to kind of disassociate themselves from the space, right? What we've seen is just complete madness in terms of valuations and so forth. And I would argue to a certain degree you still see that, right? When you see like dApps that have raised, tens of millions of dollars, but have like 50 daily users, right? And I don't want to provide names, but it's pretty easy to kind of, figure out who I'm talking about. Then that's just madness, right? When I was at Facebook, right, it's no secret we have like, we had like 1.5 billion users daily, right? And so like, I'm not saying you need that, but like tens of millions of dollars for like 50 users. I mean, that's, doesn't make a lot of sense. And so, our focus is very much like on the infrastructure in terms of our, investment thesis. I think we, there's still ways to go, whether it's, scalability or, usability. And so I think it's going to take probably like at least 2 or 3 more years until we get to mass adoption, which we will get to. We just can't get to it right now with the infrastructure problems that we have in the space. And so that's kind of our focus. But I see that as a good thing. And when I see, whether it's like the Yale endowment, like a $29 billion endowment investing in the space, or Fidelity announcing that, they're entering the space, or Goldman Sachs, right, setting up a Bitcoin trading desk, all of these are positive developments. So I'm very bullish about the space longer term, and I think what's happening right now is actually a good thing.
Cool. Anything you want to add? Then I'm going to get some questions from the crowd.
Generally, it's very, for me, I would say, timing it is obviously almost impossible. I remember during the uptime at various points, I was like, okay, this definitely is too much now. And then it went even more. It's like, okay, but now this makes no sense. I mean, people I haven't heard of 10 years are calling me up on the phone, like, it's done tomorrow. And that was like November. And then it goes up more. So like timing it is kind of impossible. What you kind of can try to do is, and what we try to do then is which we think kind of things would happen, and which were first indication of the bubble slightly going down. The same way we have a kind of a thesis which are the first indication of things will go up, and I think it very much connects what Tomer said is about usage. So I think currently it's a race to a use case outside of cryptocurrency. So this is Blockchain Venture Summit, but like everybody still kind of equates blockchain with cryptocurrency. It's actually two different things. So all of the 50, 40 user dApps which are out there, I think a first kind of application that uses this decentralization in a way that kind of actually makes sense, not just trying to put yellow pages on the internet, sort of, which was kind of the first internet use cases, and that it picks up in a way that you can see, okay, this has momentum, this will be something. I think this will kind of kick it into gear. However, I very, very much doubt that we'll get a 2017 anytime soon. I think what will probably happen is that projects that actually deliver on something that are connected to somehow one of these success cases, they will do well, but the rest will just continue their slide to zero. Because right now, everything moves very correlated. Maybe Bitcoin has its own little curve, but pretty much all of if you remove Bitcoin, you remove Ethereum, you can take everything else, and you will get basically one curve. Like the difference there, it's minor, especially on the days when it moves up and moves down, right? So you have companies which are building something, you have 20 people, you have the right attitude, you're there, I mean, coding for the sake of coding is not good, but they're definitely motivated to do something. On the other hand, you have a different company where all the founders are buying houses on the vacation, and somehow their prices are moving in sync, which obviously long term this has to disconnect as well. So once we see some usage and slowly the market kind of disconnecting bad from good, then I think this will be a slow recovery of what we have. Before that, I mean, Ethereum could go to 50, 100, 0, 1, 2000, I really don't know. I can't tell.
And to add to the usage point, I think one thing that in a lot of discussions we fail to look at is a very rational foresight into future value accrual. Even if you have a million or 10 million or 100 million users, but you have no way to extract or actually capture any sort of value from that, those users won't make the network more valuable. I think that was sort of one of the biggest issues or one of the biggest mistakes in the dot-com boom, and we're seeing it here as well. A lot of token models are modeled in a way where they assume that for some odd reason, a user who holds Bitcoin or Ethereum as their store of value will actually be happy to switch into the native currency of that network, to transact with that, and then that the user who receives that token will actually keep that and not sell it on, which means that there would be an increase in demand and with a stable supply. Actually, what's really likely to happen is that if they're really forced to use a certain token to transact, well, first of all, it adds friction, but second of all, one user will buy it, demand will go up, the other user will receive it, they will sell it, and demand will go back down, and so there will be a net zero effect on the actual token. So no matter how many users you have, you still have to think a lot about how the economics actually work within the network, and how you engineer the different actors to actually want to hold your token as well.
Yeah, on that point, I completely agree. I mean, token economics, is key, and there's so many misconceptions right now, or at least we think, misconceptions that exist in the market, right? So we take a pretty pragmatic approach, and actually, in many ways, we don't think you need to reinvent the wheel. You just need to make it better. And oftentimes, we don't see a real use case or need for blockchain in some of the projects that we look at, right? And so the question is, do you really need, a blockchain, or do you really need to issue a token in order to solve whatever it is that you're trying to solve? Just to give you an example, right? I talk to entrepreneurs pretty much every single day. One of the things I kind of notice all the time is there's this, what I call decentralization mania, right? Like everyone I talk with try to prove to me just how decentralized they are. And I'll tell you a secret, actually at the governance level, I like to see centralization, right? I like to see actually a clear leadership in place where they can be much more effective in their decision-making process, right? So when I look at for instance, Bitcoin, and I compare it to Ethereum, I much prefer the Ethereum model where you have clear leadership in place. You don't spend 2 years arguing about, a block size, which also ends up in a hard fork. So I think, there's a lot of kind of misconceptions. And again, what happened over the past year or so helped crystallize that in many ways.
Cool. So, I can get one question, I guess, if you have Yep, can I get the mic here? First row.
Hi. So my question evolves around the regulations that we talked about with the previous panelists as well. So when it comes to blockchain applications, right now there is like a good trend of, I think, the government and with the big actors involved, like banks, lots of like legislations and regulations are being talked about. So when we look at the main motivations of blockchain applications is coming from having no self-authority and being a decentralized application in that sense. As an investor focusing on blockchain applications, do you ever think or do you feel that these regulations enforced by countries and even in a more global scope, do you think that affects the perception of the blockchain applications by the public, or do you ever feel that these legislations and regulations might affect the future of blockchain in that sense? Because they are coming from individuals at the end of the day. Yeah.
Okay. So the question is, do I think that the regulations impact the perception of blockchain?
Yes, yes.
Well, I guess it depends how you look at it, right? Again, like, as I said, like, my approach might be a bit kind of different than, you know, other folks in the space. Personally, I like regulation. I'm pro-regulation. I think if you want to get the, you know, big guys involved, you need regulation. Like, there's no way you're going to get the large institutions that we're talking with, you know, spend significant amounts of capital and kind of see that institutional capital inflow that everybody is talking about without regulation, right? Like, you need, you know, you need the KYC and AML in place. And so the question is, how can we make it better, right? How can we, you know, make the speed faster? How can we reduce costs for users? How can we, you know, not have all these third-party intermediaries involved? But in my mind, it's not about how do we take on the governments and kind of, you know, discard all regulation. That, I think, is too extreme. And while I see, you know, the ideal for that, I don't think that's ever really going to work at a, you know, large scale. So again, I think the space is still evolving. I think it depends on how you look at it, right? If you talk to people who are like married to the Satoshi, you know, original white paper, they might, you know, view some of these regulations in a negative way. I think if you talk to, you know, folks at like major institutions who want to invest in the space but are worried about the lack of regulation, they would view it very positively the more there's clarity and, you know, regulation in place. And I think that's what we need in order to really kind of take, you know, blockchain to the next level and start seeing some more massive adoption and start seeing some bigger players getting involved. So personally, I think regulation to a certain degree is a good thing.
It's also important to dissociate what a blockchain or a decentralized network does versus what regulation is intended to do. If you think about, well, even Bitcoin's blockchain, what does it do? It allows a set of peers to come together and reach consensus on the state of a certain ledger, right? That happens to have allowed people to raise huge amounts of money via ICOs, but that was not at all the original intention. If you look at what regulation is intended to do, it's intended to protect everyday investors from investing into something where they might not have all the information, or they might be promised something which is just purely false, and protect them from losing their money. Now, if you look at what ICOs did, they promised, on some level, they promised a huge amount of returns to investors based off their work, which they would or would not do, depending on how you see it play out. And that is security. And so that's the role of the regulator to come in and protect that. But that shouldn't taint the picture of what blockchain is, because blockchain is just a fundamental technology which involves this trust layer, which can be used anywhere from having this ledger which accounts for the number of Bitcoins in your wallet, all the way to large institutions on sort of the corporates in the tech space that want to have trusted execution environments where they can cooperate with other tech giants without having to trust a single third party or anything along those lines. So the wealth of opportunities that the blockchain, blockchain technology in itself can actually bring is really unrelated in my perspective to regulation. On the contrary, regulation is good because it will, as you mentioned, enforce sort of the certainty that there isn't any wrongdoing going on from the large players' perspective. And on the other hand, it does protect investors who might not have all the information.
In fact, actually, the lack of regulation in many ways tainted blockchain, right? Like all the scams kind of tainted, I think, in a negative way, crypto, and definitely among kind of larger institutions.
So if you want to add something,
I can. I mean, generally, I think regulation. There hasn't been any regulation. I haven't seen like a Bitcoin law anywhere or whatever. I think the regulators have been extremely patient, considering the number of scams and what's been going in the space. All that I've seen is guidance to kind of how to apply blockchain, Bitcoin, ICOs to existing regulations. So I don't see why people are or when people kind of mention that, oh, I don't know, the Fed or whoever is the guilty party will destroy crypto with regulation. I mean, so far they have been nothing but patient, if you ask me. So of course, it's a good thing. More clarity means you can remove clarity on regulation moves. As a business, you can remove one risk that you don't need to worry about. So, yeah.
If you think about it, regulation could actually become one of the biggest allies as well. Or a lot of people are sort of worried about what regulation might do to the whole blockchain space. But if you think about what happens in a transaction that any sort of corporate does, they have to go through KYC, AML, they have to verify a whole bunch of things for compliance reasons, right? That is all done post factum. So you do the transaction, and then you have to be able to, at some point in the future, demonstrate that you did KYC, AML, or else you might get a fine. If you think about what programmatic money enables you to do, it enables you, even built into the protocol layer via things like Zeppelin's TPL or Harbor, or even things like Polymath, to effectively have regulation built into the transaction itself. So if I want to send you a certain amount of whatever it's tokenized security, that transaction might not be able to go through if you don't have some sort of either an ERC 721 or some sort of an accreditation that you have passed KYC AML, and then that transaction can go through. So you move from sort of post-factum compliance to live programmatic compliance on every single transaction. And that will be a huge benefit to anyone who's looking at regulation and compliance from the corporate side. So from that perspective, it can actually be one of the biggest assets that the blockchain space will have, in the sense that a lot of regulation and compliance can become programmatic.
Yeah, totally, and it will reduce the cost, dramatically. Yeah.
Thanks everyone for joining this panel. It was, I think, really insightful for most of you and for everyone. We're going to have a lunch break now. We don't want our food to get cold, so let's go downstairs. At 2 p.m., we'll be back in the room, and we're going to have great sessions. We're going to have David from Cambriel. He's going to be talking about generalized mining. We're going to have Jess from Codex Protocol. We're going to have Adi from Apply Blockchain, Bülent from Colendi. So let's see you at 2 p.m. in this room again, and bon appetit. See you later.